the utilities, because of complacency, um, when they're hearing Kazatomprom say you need two or three more of us by the time 2030 rolls around, or you're hearing NextGen with Arrow Project saying you need another one to two of us, right? And they don't believe it, or they just choose not to because they figure they'll go get it. To, to your point earlier, trying to bring these projects online has been brutal. Trying to build a new project despite best efforts and rosy timelines, nothing. A very small percentage, not nothing, a very small percentage of projects get built on time.
Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from social medias. I'm delighted to have one and only Mike Alkin back to my show for, I'm sure, great talk about uranium. Thanks for coming back, Mike.
My pleasure, Lucian. Always good to see you. Thanks for
Thanks,
having me.
buddy. Thank you very much. I would like to start with Paladin and the cut in their output estimates for Langer Heinrich with the new forecast at 3 to 3.6 million pounds of uranium against earlier 4, I believe 4.5 million estimate. So we are adding Paladin to the list with Kazatomprom cuts, Energy Fuel, Uranium, Orano, plus we have development project delays or unclear or overpromised timelines for production. I'm sure Mike's models have covered that scenario already. What's your take, Mike, about it?
Yeah, it's a great question, Lucian. It's hard to produce this commodity. It's just not easy in good times. Then you take projects that have been sitting on the sidelines for quite some time, and you got to get them going. In the U.S., they're having a hard time getting labor, right? So you're competing with oil and gas in certain areas, and it's a hard time. And you pay them more, and you hope they show up. And so, and you hope you could find enough of them in the U.S. anyway. That's where the challenge has been. And yeah, it's geopolitical risks, right? You have what's going on in Niger. That's a challenge. Kazakhstan, right now they're having a hard time securing acid, right? And that's challenge. These are becoming ingrained into what's happening. Kazakhstan, you have your own geopolitical issues. There have been some people there who formerly worked for the company that have been rounded up, and it's believed that they've been rounded up and put in jail because maybe they signed contract prices much lower at some point in time, and now their prices are higher, and it looks as though they did something when they didn't. They just happened to. It's called the market. So they're short of acid, right? They need more acid to be able to produce the amount of uranium they were hoping to, even though they're still in supply discipline, if you will. But the reality is, when you're a government employee and you're starting to see people who came before you just do their job like anyone else would do, and for whatever reason they're getting hauled off because the pricing didn't work out, you want to be the one to sign off on that acid plant when acid's at the highs, and all of a sudden by the time it comes online 3-4 years from now, and acid's done what it does, like any other commodity, it goes up and it's down, and people want to then know why you signed off on something that's higher price. So there are all these idiosyncratic issues, right? Niger has its own issue with the junta. You've got Kazakhstan going on, and a lot of those pounds are going to Russia and China, right? Geopolitically, you're starting to see that, where the bulk of those pounds are going there. The costs are in Kazakhstan. If you were to look at their IPO document when they were coming out in 2019, they would have forecasted $11-12 a pound to produce uranium at this time. It's going to be 28 plus for now, right? So, and that's with the tenge that has depreciated probably 40% from where they thought it would be. And so they're getting a much bigger boost because they cost in tenge and sell in dollars. And so it's tough. And then you get to a relatively not complicated mine like Langer Heinrich, and they're just processing stockpiles that's been above ground since the mine closed, and they're having a hard time. So and to what you said, other than projects that are going to come online, these things always take longer, they're more expensive, and it just in a market that that thrives on long-term contracting, where 80 to 85% of the pounds transacted over time is in that market, the multi-year contracts, there's capacity that's really not available right now. And I think that's why you're seeing the floors and ceilings on these market-related contracts continuously moving up.
Exactly. Mike, what do you think? Why do we see a slow contracting in the last couple of months? Even Sprott CEO John Ciampaglia says that it's not expected and they are confused sometimes around the utility behavior. What game are the utilities playing?
Yes, so that's a good question. So, let's wrap some context around what we're talking about. So contracting is the lifeblood of a uranium company and a nuclear power plant. Why? Because there's no substitute. There's no switching, right? Coal, you could switch to gas to coal. It's not the case here. It's uranium in its processed form, right? In converted, enriched, fabricated, and a couple of years later, it winds up there. But there's no substitute. So contracting is the lifeblood for security of supply purposes, because it takes 18 to 24 months to secure it and turn it into fuel. What you've seen historically is over time, consumption in a given year is normally replaced with contracting in a given year. In a perfect world, it never happens that way. What winds up happening is the industry has been defined by booms and busts. And when you have events, whether it was 3 Mile Island or Chernobyl in the 80s, 3 Mile in the 70s, Chernobyl in the 80s, you then have these lingering hangovers where enthusiasm turns to doom, and then there's supply that's sitting out there. And what you wind up seeing is that the contracting occurs at a much smaller rate. And what the industry, because demand has slowed down. Demand has slowed down maybe because plans that were to start new reactors have been shelved, or they accelerate the closures of other reactors. And that's what you saw in the 80s post Chernobyl. And without getting into and all of this, by the way, and on the backdrop of nuclear being the safest form of electricity generated per terawatt hour, but it does weigh on people's minds at times. And if you look from the late 80s up until about 2004, what you saw was every pound consumed, there was only replaced under long-term contracts in a given year by about 35%, roughly. And so the balance was coming from drawing down above ground inventories. There were excess inventories because demand had slowed. They drew them down, they drew them down, they drew them down. And for those who, I'm sure people paying attention or listening to this have some interest in it, they may have seen it and may know the fundamentals, but the cost of uranium is de minimis. The front end of the fuel cycle is about 20 to 25%. And I'm talking about upstream to downstream. But it's 20, 25%. But the fuel, the uranium itself is 5, 7, 8%, depending on the price. But so it's small. Gas and coal are 90% of the feedstock. So when they need it, they go buy it. They buy it for 5, 7, 10, 12-year contracts. When they get to the point where they're not replacing it over time, eventually, people, complacency kicks in because recency biases kick in. Oh, there's plenty of it above ground. We haven't recontracted at replacement rate in a long time. Then all of a sudden, you can have forecasters that are out there, but a lot of times the forecasts are only as good as the paper they're written on. Here's surplus, here's deficit. And when you see a constant stream of surpluses, you become complacent. And then all of a sudden, contracts start to expire. And then they go in and they start to, when more than 100% start to replace, that's when you see how much economic capacity is available. And you take the last cycle from, the price of uranium settled in at $7 in the late 90s, it stayed till about late 2000. And then by 2004, it had risen to in the high 30s. And in 2000, and replacement rate was still about 35% of consumption. So again, no real call on available economic capacity. It was still kind of the status quo. But quietly, prices had ridden 5 or 6x, right? That's a bull market, but nobody was talking about it. It didn't feel like a bull market, even though it was a bull market. And then all of a sudden, in '05, utilities, because supplies were dwindling, even though it wasn't forecasted, they wound up contracting at 115, 120% of their annual consumption. And that kicked off prices a lot higher. And then there was a series of events that by the time you got to this peak in 2007, there was a mine flood in October of '06. There were biggest mines that wasn't coming online now. Prices went to 137 or $200 in today's dollars. Fast forward, right? That lasted, the prices drifted back to the 70s, and then Fukushima came in March of 11, and here you are. They stopped contracting. And they did the same thing. It was high 30s% from 2012 to 2022. And what was happening? Supply was being cut. In the last cycle, it was very different. So if you looked at when prices started really spiking, and this is something, when you're studying cyclical industries, you can't study history enough. There's just no, you can't read enough history. You can't talk to enough people who lived it, or if you were there yourself. And this is the part about the last cycle that's so different from this cycle. And I've said this many times, but it's real and it happened. And if you looked at the forecasting back then, the modeling, the forecasting, and you're a fuel buyer, and you come in before that big flood in October of 2006, when the Cigar Lake mine, which was the highest grade mine and biggest mine, 18 million pounds per annum. For context, that was roughly 10%-ish of global demand, was supposed to come online in '07, and there was a flood, and it caused it not to come online. Now, the price of uranium went from the high 40s to the mid 60s from October till around January. And that's not unreasonable. You would think, okay, well, the world's biggest mine, that's got to impact the supply-demand dynamics. But if you were a fuel buyer before that mine flooded, and you looked out and said, okay, I'm probably going to contract 6 years out, 7 years out, and you looked out over that time period, and you looked at the industry forecasts from the forecaster and the sell side banks, you would have seen a surplus in that market of 125 million pounds, right? That was real. Yet there was a hiccup. The world's biggest mine isn't coming online, and all of a sudden they go in to start contracting. Even though there's a surplus, the producers said, "Oh, okay, look at them, they're coming." Looking around saying, "Well, if they're willing to pay up for it, even though we have some excess capacity, we're willing to sell it to them there." Now, fast forward, the first quarter comes around of '07. The world's largest mine scheduled to come online, it's very clear, is not coming online for many years. Yet the forecasters over that next same 6 years came up with another 100 million pounds of supply. And you would have looked down as a fuel buyer if you were looking at their forecasts, and you would have said, "Oh, wow, look at that. There's 225 million pounds in the market, extra pounds." Yet the price went from the 60s to 137, 200 in today's dollars. That was, and then eventually by 2014, the mine came online. Now, fast forward to today, you have structural deficits. So if contracting were to meet economic available supply, you're short, and depending on demand numbers, which are calculated because of enrichment capacity, 15, 20 to 40 million pounds a year. It's big, right? And we have all different scenarios that we could do, but it's not surpluses. It's just not. And so to your question is why are they stepping? What kind of game? I don't think they play games. I think they go into the market when they do. They've become incredibly complacent, and for most of the time, the fuel buyers get it right because the prices are depressed. But then, just like anything, you overplay your hand, and if you overplay your hand because of complacency, it comes back to bite you in the butt. And that's what happened in '05 to 2011. And then the same thing has happened since the bottom in 2017 at $18 a pound, and we're now sitting at 80. But you made a reference is why is contracting slowed? So I would look at it a little bit differently. You were at 37% of replacement rate up until about 2022, and then you saw in 23 you saw 160 million pounds, 150 million pounds contracted on the industry forecaster will use 180 million pounds. We use 200. That's our math. But it was meaningful. You were getting towards replacement rate, and the price, and this is something that's the price. What does the price mean? Because the price has different meanings to different people. The contracted fixed rate price rose pretty dramatically. Now you get to 2024, and up until by the end of September, only 53 million pounds had been contracted. Okay. Now we get to understanding market structure and what I think it would help investors to focus on. At least this is what we focus on. We might be wrong, but this is what we focus on. That's a market structure. So 53 million pounds when last year was 160 million pound run rate, you're through September. But the fixed price, which the price forecaster quotes, which is a base escalated price. It's a price where utility and nuclear and uranium producer fix a price and they escalate it up by typically CPI. And it's for delivery that starts in 3 years. That's the price the price reporters report. That's a price that's really relevant at certain times of the market. Utilities prefer to have certainty. So when it's a buyer's market, the price that's normally signed is a fixed price. When it's a seller's market, the seller wants exposure to spot. They want to the prevailing market. They want prevailing prices at the time of delivery when they're sensing their own animal spirits that supply is going to be tight. That's called a market-related contract. That is where there's no fixed cost element to it, but the utilities will want ceilings, and the producers want floors, right? So that is when you start seeing more of that than you do the fixed, you've transitioned from a buyer's to a seller's market. That's where we're at today. But if we look at but the price reporters do not report that price. So when you've transitioned in a market that's gone from a buyer's market, the price that's reported in a seller's market is still the same price being referenced in a buyer's market when it's very different. And for context, if you are a producer today, Cameco just said it on their conference call, right? And if you do work in the industry and talk to people, you come up with very similar data points. With the spot price, it's sitting at around, which we could talk about, sitting at close to 78 today, 78 and change, 79 on the ask, I think. You're looking at $70, $75 floors and $130 ceilings. So just think about that for a second. I'm the producer, and I have $5, $7, $8 downside, but I have $50 upside. That's spectacular asymmetry in favor of producers. That price never gets reported, though. Nowhere do the two price reporters choose to do that. They choose to not include that in their price reporting, even though that's where the market is. Instead, they report, and there are still fixed price contracts that are signed. A brownfield play wants to get going. A new project needs some certainty, so they get some fixed price contracts. But now the bulk of them are going the other way. It never gets reported. So let's use that, since that's what's reported. Through September, you had 53 million pounds contracted for, materially below last year's rate. Yet the fixed price contract was up 23% year to date. Now, these are commodity markets. It's very simple. Too much of something, prices go down. Too much, too little, they go up. So what is the market testing there? The market is testing available economic capacity, right? How much capacity is available that a producer can make money on? Not all that they talk about. not all the rosy projections that are out there. When the rubber meets the road, how much can be signed? Right? With volumes down materially, prices are still up 23%. So what's happening? So you have fuel buyers. So a couple of things that's telling us. Number one, a lot of the discussions, a lot of the contracts that are signed are these contracts materialize in a couple of ways. When utilities want to see what's out there and test the waters, they'll put a lot of request for proposals in the market, RFPs. They go out to the producers. XYZ utility, we want to buy 1.5 million pounds starting in delivery in 2026 through 2029, and this is what we're going to buy. Please respond back by this date and time. And then you see what's coming in from you, and then you know. That's one way of doing it. The bulk of contracting doesn't occur that way. The bulk of contracting is bilaterally negotiated. It's a relationship business. It's based upon salespeople calling on fuel buyers. And over many months and sometimes even longer years, these contracts are worked on and negotiated. And then they may or may not be reported in a timely manner because there's no mandate to do so. So when you're starting to see it really tighten up, you will see more bilaterally negotiated contracts as you're seeing now. So you don't really know the volumes. For instance, in October, but just if you step back and use commodity common sense, the volumes at 53 million being reported are inaccurate when they're materially down, but prices up 23%. Well, then October comes along and the price report has found 37 million pounds, and now you're up to 90 million pounds, right? We feel very certain there's a lot more pounds that have been signed than what is, because they're seeing RFPs. And again, that's not where the market's at. So you got to know the market structure, and it really helps to understand that. And so we do think that there are some fuel buyers that take this very common view. You know what? And they were going into the election. You know what? Trump's going to get elected. Maybe he gets elected. Trump will get elected. Any Russian ban on uranium, it will get lifted. So our short-term problems, enrichment issues, the Kazakhs, transportation issues out of St. Petersburg will be solved. We'll get some pounds from the Kazakhs. It's all going to be fine. Not worried about it. And you know what? We'll worry about it then. And if we have to pay, and so why would you do that, right? Because if you're a fuel buyer, like there is no substitute. And this goes back to market structure, right? Who's a nuclear fuel buyer? Mostly nuclear engineers, incredibly smart people. But they're not paid on profit and loss of buying nuclear fuel. They're not paid on that. They're paid to secure it, right? Their job is to secure it at what they need to do. Now, they will try and pay less, but at the end of the day, if push comes to shove, some utilities, and not everyone is out. If there's a structural, there are some utilities that have more than they need. There's some producers that might have more than they need, and they'll do swaps and they'll do other things, location swaps, where they can solve a problem short term. But again, that all comes at a very significant price. But they're not penalized for paying up for that. So it is what it is. And so I think that's kind of where you're at. We just follow what's happening in the marketplace. You can run, but you can't hide. Let's do this math. By 2030, roughly 25% of the pounds that will be needed are not in the form of a mine yet. They don't have approvals yet. They don't have permits yet. They're not licensed yet, and they're not built, right? So a lot needs to go right by that time. Then you have a lot of brownfield, another 5 to 8% that needs to come online. And I think sometimes the utilities, because of complacency, when they're hearing Kazatomprom say you need 2 or 3 more of us by the time 2030 rolls around, or you're hearing NextGen with Arrow Project saying you need another 1 to 2 of us, right? They don't believe it, or they just choose not to because they figure they'll go get it. To your point earlier, trying to bring these projects online has been brutal. Trying to build a new project despite best efforts and rosy timelines, nothing. A very small percentage, not nothing, a very small percentage of projects get built on time. So they're playing with fire. And we do think there's been a lot more contract, and it's been reported, and it's showing in the fixed price. Those floors and ceilings I mentioned earlier, they were $20-$30 lower last year, right? So they were materially lower. So yeah, so that's it.
Yeah, all great points, especially the part with next gen and overpromised projects. I agree
And
100%
and
about
look,
that.
I think who knows when it will get approved. I'm not saying they're over promising, but it's a timeline that they have. Timelines for them or other projects as well. They're always dramatically challenged.
Yeah, yeah, agreed, Mike.
Yeah.
Let's take this from another angle. I mean, the utilities. Do you believe? I had John in my show, I don't know, a few weeks ago, and he said one interesting thing that utilities think that they will get a hand on their pounds that spot holds. Do you believe that they are really relying on that, that they could?
I think some do. I think the bulk of them probably don't. I think some do. I think some. My experience with them, I go back. I was in 2018. I went to the Nuclear Energy Institute, the largest trade body that represents the interests of nuclear power to Congress. And I went to them and said, "You don't know me, but we just did a lot of work last couple of years, and I think the numbers that everyone's looking at are wrong. And I'm not a nuclear expert. I'm not a uranium expert. I'm not, I'm not a physicist. I have no, I barely know how they work. I think I do, but at a novice level, but I can do supply and demand math. That's what my thing is. If I have a thing, I think that's it. And we've spent the last couple of years looking at this back in 2018, and kind of the math doesn't make sense. The math that's out there that people are using for forecasts. And they said, yeah, whatever. Who are you? Who are you? And then we just kept a dialogue going. And we did a presentation and for them and showed them. And they said, you know what? Come and speak at our annual meeting. The fuel buyers should hear this because you're an outsider. You have a different perspective. It's great to hear a different perspective. And it was in Boston in October of 2018 at the annual conference where I stood up and I literally stood up on the stage and I said, "You guys have done a remarkable job. You've stayed out of the market for many years. Kudos to you. The price of uranium had gone from 137 at the peak down to 17, $18. I said, but I said, but we've spent a lot of time the last couple of years studying the market. And not far be it from us to know more than you, but we just have a different view. And let me share with you the view as to why we think now is a good time to be contracting, because the supply demand numbers that are being presented, we think are stale. And, I don't know what it was, a 30-minute talk, and we laid it out fairly coherently. I got off the stage and somebody approached me and said, "How dare you come here and scare these people?" And I said, "What?" They said, "You're just a bad Wall Street guy." I said, What is, I don't even know what that means." They said, "These are good, hardworking American people, and how dare you? These are my friends." And I said to this person, you just described me. I'm a good, hardworking American person. What separates us? Um, and that attitude has permeated. It was not, hey, standing around the bar in the evening. Hey, you want to, like, I buy this stuff. Let's have a beer. Love to talk to you about it. That wasn't the conversation. And I've been doing this for a long time. And I've looked at myriad industries. And on the other side, I wasn't even on a side. I was just sharing some research I had done. Uh, but there's always people who are buying and selling, but the people buying want to hear different viewpoints and different perspectives. That ain't this cohort. That is not this group. And it was my first, I had spoken to many in 2016 and 17, but this was speaking to a larger group, presenting my case. I was always asking questions before, and then now I had formed an opinion. And when I shared my opinion, it was really attacked. And then that permeated, and I thought, okay, you know what? I'm going to get some phone calls here from people, and crickets. And then there's a series of conferences throughout the year for the industry. So I went to these conferences, and I would talk to fuel buyers there and traders there. And I was mocked. And I thought, well, this is fabulous. Like I can't ask for more because they don't want to hear what somebody with a different perspective has to say. Well, the NEI asked me to come back and speak again to the same group in 2019. And I did.
There you go.
And I gave a message plus. And I said, again, here we are. And the price of uranium had moved up, I forget, $8, $10. And there was even more hostility towards me for doing that. And I thought, this is crazy. I'm giving you a different perspective. I might be right. What's it cost you other than to listen?
Exactly.
And only a handful did. And the rest were very aggressive in there. So I don't, do they think they're going to get those pounds from SPUT? Some do. Some think, you know what? This is a stupid vehicle. This doesn't make sense. What's the purpose of it? Eventually, investors are going to tell them they're done. What that ignores is it's a vehicle, and as is yellow cake, it's a vehicle that provides investors who don't want to own a mine to express a viewpoint on a commodity that they think might rise without, we can buy and store and own physical uranium. But you got to go through a lot of bells and hoops to do that, right? You can't just have it delivered to your mom's garage in the backyard.
Yes.
So, we'd store it at a site or a few sites around the world. So for an investor might say, I want to express my view that way. And that's what this vehicle is designed to do, right? It's Hotel California, pounds in aren't coming out. They've set it every which way till Sunday. And the utilities just think at some point we'll get it. That's a cavalier approach, is kind of how we view it. But let's say they did, right? And I don't think they do. But we're talking 60 million pounds of uranium in a contracting upcycle, right? We're looking at deficits of several hundred million pounds over a period of time. And this isn't like you can turn the switch and put a drill bit in the ground and put a well in and not too long after you're pumping out oil. That's not how this works, right? You need mines, you need incentive prices for mines. This is years and decades to do. So if they had their perfect scenario, which I don't think occurs, there's no reason to think it occurs, but let's say it did, and it won't, I don't think. Okay, so now you solved, I don't know, 1/5 of your problem. Now, what do you got next? Right? So it's a stunning, an apathetic approach for those who take that approach. So they're always, and in fairness to them, most of the time they can get what they need. And when they don't, it goes from 7 to 137 like it did last time, and nobody gets fired. It's just how it works. But no, I don't think they do.
Yeah, you mentioned RFPs. Do you believe that multiple RFPs temporarily lock up spot and term price discovery by putting bids and offers on hold?
Yeah, I think so. I think there's some games played there. I think they also know, hey, you know what? There's going to be some small junior miner that wants to restart production, and they'll come in 100,000 pounds, and they'll put it in at a lower price just to get something on the books. And so the world will sit there and go, wow, they just signed it at whatever. I don't pick a price. A utility will say, oh yeah, because they talk. Oh yeah, we just paid $80 for that pound on a term price. When really, 1 or 200,000 pounds sets the market in a market that's 200 million plus pounds a year, well north of that. Like that's stupid. But those are that we call that like the not seeing the forest for the trees time. And that's kind of where you're at. Like people are still running around looking for little data points, right? Little data points, and I just think that's like picking up nickels in front of a steamroller when you do that.
Yeah. Do you have some fresh info? How are we looking with inventory levels according to your informations? I saw that UxC confirmed inventories reaching very low level.
Yes, they have. And we're a client of theirs, and we have been for many, many years. And I give them credit because I give them a hard time sometimes publicly and not over the years. And it's never personal. It's just a different viewpoint. And to their credit, they're very gracious and they listen to us, and they do. But yeah, from an inventory standpoint, I think their term is, and I don't want to speak for this, like the inventory overhang is over. And yeah, I think they recognize that. And what people tend to do is they look at absolute number of pounds. It's not there's it's like I was listening to somebody the other day and they said, oh, there's plenty of uranium in the world. And no kidding. There's not plenty of economic uranium in the world. Very big difference. It's just like that. There's inventories in the world, but there's not economic mobile inventories in the world that can solve problems right now. They can solve onesies and twosies, but I mean, one of the things we never forecast, we're still pretty much working off of when we started this, that there was very low growth in the nuclear industry. And all these years later, when we see all these announcements and whether it's data centers or SMRs or all this stuff, we barely put this stuff in our model. And we're still coming up with these things. Will they happen? Yeah, but we don't need it. And you're seeing a dramatic change. I mean, the administration came out today in the U.S. or yesterday and said, we want 35 gigawatts of new build reactors over the. I mean, that's right there is 17 million pounds a year of consumption, roughly, for the U.S. market, in a market that consumes 50. That's going to have a hard time meeting its own supply needs based on current supply demand. Now, all of a sudden, the incentive price to build new stuff goes up a lot. And I don't think that's accounted for.
Yeah, spot referencing long-term contracts incentivize fuel buyers to suppress the spot price through manipulation or non-participation in the spot market. Given the enormous importance and the size of the term market relative to the spot market, what might overcome these incentives?
It's a great question. I would argue it's a fairly broken industry, right? We're here because there's asymmetry in the risk reward of where we think ultimately the price has to pay. But it's one of the reasons I think things always take longer because things are priced, for instance, offtake agreements that come from a mine to a trader. They're priced at date and time certain in a market that barely ever trades, right? Very illiquid. And in a market where there could be multiple offtakes coming, where the price is, a midpoint of a bid and an ask that are moving around, not necessarily a price that's trading. So that lends itself to things that can look unusual. And it happens. It's just, but over time, all these little games there, and I use that term, picking up nickels in front of a steamroller, that happens, where people are scrambling to try and solve things they didn't anticipate and plan for. So, you could see fuel buyers saying, hey, we want to stay out of spot. We might need a few 100,000 or pounds, but we're not going to go in because if we go in spot, we're going to move the price up because there's not a lot of it, right? Like, for instance, recently, the spot price of uranium has gone from, in the more recent, it went up to 106, and then that was there for a cup of coffee. It was barely there, but it was 85, 90, 95, up from 50s, right? A year plus ago. So it had a huge move, and then it's taken a breather. It's consolidated, and then you've seen it drift from the mid 80s to the high 70s, and everyone's like, "Oh, that's it. Too much supply." No. First off, the spot is a small disposal market. That's for just some pounds that are unspoken for. Most pounds are. But since September, the ANU fund out of Kazakhstan that was owned by the Kazakhs was set up a few years ago with the hopes of becoming a big physical vehicle and all. And it wound up having 2.5 million pounds, and they shut it down. And so you had 2.5 million pounds that needed a home. And because they were looking to sell it, they put some RFPs in the market with some stringent requirements for the buyers. And so for September and October, there was this fear of 2.5 million pounds coming at 2.4, 2.3 million pounds coming into the market and swamping the market. So let's just step back and think about what that is. We're at a 200 million-ish year plus demand market. you're talking 1% of annual demand. You're talking literally a rounding error. And you're talking that everyone, whether it was in London, which my back hurt, but I have got, we have people there, or other conferences, that was all people were talking about. The Anu pounds, they're going to dump it on the market. And all of a sudden, what do you see? You see traders selling 50,000. Normally they're 100,000 pound lots, selling 50,000, because nobody wants to get swamped. Why? Because the balance sheets that these traders have is something you couldn't even comprehend, so small versus the world of energy, and for something that's 12% of global supply. So you see this, oh, too much supply. I send my guys to idea dinners at investment banks, and they come back, oh, short thesis is all supply. Look at spot market. Oh, okay, got it. No, it's a fund that needs to clear some pounds. Well, we believe those pounds are pretty much cleared and mostly spoken for, and a little bit strangling out here or there, small. But that creates this thing in the market to the point where I got a call the other day. From a utility asking, would I be interested in going in the market and buying some pounds for a utility, because they need it for January, but they don't have a utility. They don't have the balance sheet right now to do it. Would I do it? And I could make a fraction of a point on it. Well, why are you asking me? Yes, we do. We can and do buy uranium, but go ask one of the traders who do that, right? My thing is equities mainly. Well, near the end of the year, they don't have the balance sheet to do it. Wait, you don't have a balance sheet to go buy $8 million worth of uranium? Are you kidding me? Right? That's how thin the market is, right? So it takes nothing for it to go to the upside. Had Anu not been around, and who knows the motivation, right? They're closing the fund. Who knows the motivation? Because those pounds were bought at different prices. And again, back to what I said, it's a tough place to be an employee. You don't want to get things wrong just because you did your job, because that could come back and cause you really serious problems. So that overhang creates all this noise and people chasing data points. Just step back. That's how, I'm not telling people what to do. That's what we do. Say, all right, there's a huge mismatch in economically available supply. Inventories are low. The biggest bellwether forecaster says that, and one that we have not agreed with a lot over the years, but we agree with them here. It's just differences of opinion analytically, but they're saying it. And there's a series of little events geopolitically. There's a series of little events trying to get mines going, trying to get them built, trying to get them permitted. You never know what it is, but there's that one thing that just sets off, trying to put a pig through a python, and that's kind of where how we think about it.
Yeah, about conversion. The conversion bottleneck puts downward pressure on price of U3O8 and makes overfitting impossible. How and when do you expect the conversion bottleneck to be cleared?
They talk about that. Yeah, you'll see capacity. The conversion price in the spot market is near $80 a kilogram. It was $4 in 2016, right? So the market has a way of healing itself, and you get to see more capacity can come online as the end user is looking. The utility is willing to lock those pounds up for it. So I think that does. But look, I just saw one of the brokers was marketing EUP, enriched uranium product, and I don't want to get too far in the weeds here, but with tails at 0.3, which are very high tails. As enrichment demand is a function of the amount of tails that they use, which is driven by the amount of capacity. And some people use 0.22, and when it's underfeeding, you see them down into the teens. And when you get to overfeeding, you start to get higher. There was some EUP, a little small amount, somebody was trying to sell with very high tails. So you don't I'm not even really worried about the overfeeding aspect of it. That will come as enrichment capacity is not available, they'll have to overfeed. The conversion capacity will come online over the next few years, because we're not looking at overfeeding in our modeling for tomorrow or next year or the year after. It's down the road.
Yeah, but there appears to be an onshore glut of EUP at the major utilities. How long do you expect it to take for this glut to be cleared?
I mean, glut's a big word. EUP is their final product. I don't think it's going to be long. I don't think, you know, it's hard to get a glut when they're just trying to get 25% of the EUP that comes in the US is from Russia, right? So there's a ban on that. They're trying to get waivers on that. So they bring some in and they try and get it as soon as they can. But I don't view it. I don't view any gluts in the fuel cycle hampering price discovery over a period of time in uranium.
Okay, but what about China? China has demonstrated willingness to sell EUP to the West. Setting aside the China's plans are measured in decades trope, shouldn't we expect China to continue to make its reserves available to the market, especially now that it's established long-term security of supply through its relationship with
It's a
Kazakhstan?
yeah, it's a very de minimis amount. China's not going to the U.S. utilities are not going to put a reliance on China like they've had on Russia. So it can be a point of, hey, can you bail us out here? It could be a point of we're going to take in some, but not a lot. China's got their own. China has to worry about enriching for their own massive build out. So we don't see it as, yeah, it's there. They're great talking points, right? Because everyone needs a talking point. At the end of the day, it solves, again, this is a tsunami of supply that is needed that's not there. And so we're looking at enrichment and conversion prices that have gone parabolic, conversion prices up 20x, enrichment prices looking up 7x, uranium prices up 4x. Those are the services, enrichment and conversion. You don't buy the service without the product. The product is U3O8. They work backwards. So they're securing their enrichment. They'll try and get some in. There's a huge push, by the way, too, to block the Chinese amount of EUP that could come in too. This isn't like with the Russian ban. Everyone was asleep for 20 years. Nobody really cared. Oh, Russian enrichment's coming in. Flipping the switch to try and get Chinese is going to be met with heavy resistance from those in charge. And so, not the buyers of it, they'll take it from anywhere. But you don't, as you look at these cycles, you don't see two parts of the cycle move with ultimately the third part. And the third part is the product. And that product has to, not has to, but that product is, as the services are contracting for, they ultimately need to go and contract for the product. And the product is uranium.
Yeah, we touched on Niger at the beginning of the interview a little bit. I would like to expand a bit. Is Niger actually investable? We saw today that the authorities of Niger are unlikely to allow French companies to mine uranium on their territory and calling Russian companies to mine uranium. Is Niger investable?
I'm not smart enough to know that. I know just from how you allocate capital, I know my my view is we have very de minimis exposure there. Because I don't know what a junta is going to do. I have no idea what these banks are going to. I just don't know. But Orano was mining, right, at West. It was a French colony, Niger. They've been mining uranium there for 50 years, and they can't mine it right now, and they can't get to they're out. They got booted, right? So,
Yeah, that's my main question, actually. They were mining uranium from 1971 in Niger. Will Orano be acquiring other assets in Africa if they are totally kicked out of Niger? There must be a short of uranium for them.
so yeah, it's tough being them, right? They do conversion and fabrication or enrichment, right? So they're vertically integrated. Orano being the state-owned French company, and France derives 75% of their electricity from its nuclear reactor fleet. So it's huge, and so Orano supplies those pounds. When you do the math and you start to think about they need pounds. They're partners at MacArthur River and Cigar Lake in Canada, which they get a good amount of pounds on. But it's hard for them to besides supplying their own reactor fleet, it it's very hard for them to be a real competitor on the uranium stage globally for long-term contracting unless they go out and secure pounds. And, they're trying to go to do something in Uzbekistan, try and do something in Mongolia. Tough neighborhoods surrounded by Russia and China, right? In that same neighborhood. Um, it wouldn't surprise me and I know nothing, but I wouldn't surprise me to see them have to go and look for more supply in the Western world.
Yeah, there was some speculation that they're searching projects in Canada, in the Athabasca.
It would make sense. They should. They know it, right? They know they know the eastern side of the basin. They're a partner there. They're very smart. They know what they're doing. They're good explorers. They know all the projects. I would be surprised if it's not top of mind for them.
Agreed. Mike, do you know average numbers of how much of strategic uranium inventory do nuclear power plants hold? I was reading the other day a yearly report from my nearby nuclear power plant, Krško in Slovenia, and they have put the column of the strategic supply of nuclear fuel. They didn't have it before. So did I miss something here? Is that something new?
No, I mean they try to keep around the Western Europeans. Euratom is the agency that really oversees the European nuclear fleets, and they strongly suggest that they keep 3 years of supplies around, of inventories around. The U.S. does not have that. The U.S. is more cavalier in their approach towards security of supply, and you will see them at 2 or a little bit less than 2 years. I think the Western Europeans probably approach I agree with more. But they all keep some around because it's the length of the fuel cycle that they're keeping. It's, like I said, 18 to 24 months. So there's not a lot in reserve. It's just enough to get them through that next load.
Yeah. But I didn't see that before, so that's the reason why I'm asking.
Well, they don't, if you read, it's really, I remember many years ago when we first started looking at this, you'd go to a utility balance sheet and you're like, I just want to know how many pounds of uranium you have. But they don't report that. You got to really dive through to try and figure it out. And it's still
Yeah, you got to dive. That's true. Mike, I have few questions from my followers as well. We can cover them all, but try to keep 2 minute answer from all of them because there are few questions we
true.
should cover. Give me a second. Okay, let's start with the first. Just one moment. Okay, the first question, what is your take on can-do reactors?
Yeah, I mean the heavy water ones, they don't require enrichment. Canada uses them. There's a handful. I think they're fine. I think they're fine. There are a very small number of them in the world. Bruce Power, you look up in Canada, they use them very well. No, they're fine. They're solid reactors.
Okay, the question, the last peak in uranium prices was brief moment in time measured in days. Should we expect today's more sophisticated, transparent, and self-aware long-term contracting market to behave in a more orderly way, looking past and temporarily supply crunch and surpassing the amplitude of any peak in pricing?
I don't know the answer. Trying to figure out how fuel buyers will behave is difficult. I could just study the past and know what we know from the talking and speaking with them in the future, in the present. And um, like I said, in the last cycle, there was a surplus in the market and prices went bananas. They went parabolic. There's a deficit in the market now. So, structural, not you can't find 2 million pounds in spot market, 500,000 pounds, a nano pound or something like that they were marketing. I'm talking about real large pounds that meet contracting needs. Um, when they start getting to that point where they're contracting to their annual consumption, there's just a shortage. And so I would suspect you would see spiking and it it's a groupthink behavior. They're all very comfortable and relaxed until they're not. And I think that's what you have to look for. So I wouldn't expect, I wouldn't expect anything orderly. There's nothing orderly about this industry, right? Um, it's structurally dysfunctional.
Yeah,
It is.
yeah, it is. Next question, AI and data centers, when will that start to have a significant impact on uranium demand?
It's a really good question. It's one that, how you think about investing too is, in the spring you saw some of the big tech companies signing deals. AI data centers started to come into more relevance and play, not relevance, but people really focused on it. And nuclear became a way to express that view. And you saw the uranium stocks, being talked about on CNBC and Bloomberg, and stocks were going like this, and I know one thing, I think, I don't know a lot, but the price of uranium today could not care less about data centers, signatures today. The fuel buyer today does not care what's going to come online in 4 or 5 years. So taken in context, you have to understand, is this a segment of the market that has acknowledged that they want nuclear powered data centers? Yes. Is it going to provide a nice tailwind to the industry? Absolutely. Is it going to cause the price of uranium to go nuts in a week or a month after a few signings? No. And so, you tend to see a signature, everything goes nuts. And then the price of uranium doesn't do anything because there's 2 million ANU being marketed, and people are like, oh, geez, okay. So they're misaligned sometimes, right? Does it ultimately lead to really significant tailwinds? Yeah, but people need to know the time frame. It gets trickier as the popularity of uranium and nuclear. It's hard to turn on your computer, or you look at your phone without a headline if you're paying attention to it, that's something good for nuclear. But that's created more interest from investors. More institutional investors are coming in, um, you know, and large hedge funds will come into it, and they bring their own perspective to it, and their short time horizons are much shorter, right? So you have to kind of read the tea leaves as to how they're thinking about it, what they're thinking about. Sometimes they have different views. They might say, oh, one of the things we hear is, well, the Kazakhs, when they ramp, like, wow, that you still hanging your hat on that when the Kazakhs ramp? Okay, let's get past the hurdle that they're short of acid. Let's get past the hurdle that their costs have spiraled out of control for a long time now. Let's get past a lot of hurdles. Let's say you're right, Mr. Really sharp guy, and the hedge fund and the price of uranium is going to spike, or I'm sorry, is going to crater because the Kazakhs are going to go to full allotment that they could do, their subsoil use agreement. Now, where are you going to come up with the extra 20 to 30 million pounds of market short? What do you got for me now? So, but they take data points, and they're talking data points, and that's how they view the market. They have large pools of capital, and they're the ones who swing things around. So they're the incremental buyer and the incremental seller at certain times. Other times they go away, and they're very sharp folks, but they tend to look at it through a very small lens. And they come into it, they hear about it, they do it, they get there, they focus on rate of change. It's all about rate of change. Kazakhs, they're going to ramp, it's rate of change. Okay, well, let's just step back and put it all into context. So that makes the trade more volatile at times. So yeah, you got smart people with different views and different opinions looking at things.
Of course.
But it's not a regular market, right? It's a dysfunctional market. You have to have lived that and know it to
Yeah.
understand it.
Yeah. Next question. Market view is that the replacement rate contracting is not yet reached. What's your take on that, and how do you see it going forward?
2 steps forward, half step back. They're getting there. Again, you never know what the trigger is. You just know that the ingredients are there for it all to occur. You don't know what the flashpoint is. So, you know, I've truly I've given up trying to figure out what utilities really are going to do. I know what they have to do, and within a reasonable time frame that I think they have to do it. What I think they have to do is week to week, month to month, quarter to quarter. Who knows?
Yeah, next question. We are seeing support for building the plants in the United States. Does Mike have an opinion on whether the US government will provide support incentives for domestic uranium miners given the lack of domestic supply?
Yeah, I think you've seen that they are giving out some support. There are programs in place where they're giving the money. I think utilities certainly are showing an interest in U.S. Mines. You know, you go back just real quick. In '83, the U.S. consumed 50 million pounds and produced 44 million pounds. Now it's, you know, a million and change, something like that. It was zero not too long ago. So I think, yeah, I think there's interest in it. I think there's support from the government. So I do think you see that.
Okay, next question. It's interesting. The guys at Ocean Wall mentioned in an interview they would advise UK government about nuclear. If the incoming USA Trump administration were open to it, would you consider guiding them to the road of revival China in energy superiority?
No, I don't. I'm not that guy. I'm not qualified. I don't know why investors think they're qualified. I'm not qualified to guide anyone on energy policy. You know, my job is just to look at supply and demand and see where I think that there's an imbalance. But that's not my gig. I
Yeah.
don't know. Yeah, so someone else can do that.
Yeah. Will China, Russia force Kazatomprom to be 100% nationalized again?
Great question. I don't know the answer. I don't know the answer. Um,
That's
would that
okay,
surprise
Michael. You
me?
don't have to know everything.
Yeah, that wouldn't surprise me, but I don't know.
Yeah. Next question. The price of uranium is already above incentive price level. Why should we expect the price to rise any further?
Who said that? Why, I don't need to know who, but why do you think it's above incentive price level? Not you, but why does that person think that? I don't think that it is. I disagree with that.
Agreed. Yeah, has anyone been able to calculate with any degree of accuracy what uranium inventory US and European utilities are carrying? Is there a definite date in the sand, say 2025, 2026, where they have to start contracting above replacement rate?
No, it's these are much soft. It doesn't, you know, there's not a, a page you can open to and say, here's the amount. There are the Euratom and the EIA, Euratom for Europe, EIA for the US. They do have each year, each May, they put out what the how much inventories that are estimated to be in the utilities. So you can figure that out. In terms of when they do, you know, these are all soft things. It's just there's a lot more. You need to, one of the things that, you know, you need to look at is when the contracting, what the waterfall, what the uncovered requirements are. Contracts roll off, how much needs to be covered on the contracts. You know, you're looking at, what are we in 2025? You know, you're probably looking at billion and a half pounds over the next 15 years. And I'm just working off of memory. You know, go to 2035, a more realistic time frame, still a lot. You know, I don't know,
Yeah,
somewhere under a billion, but it's a lot of pounds, right? So at some point they need to go into the market.
yeah. What's Mike's take on why did the uranium equities tank so badly in the summer? Is fall contracting over, or are November to January going to be a pretty active?
I think people stare at spot price. And if spot price, the rate of change of spot price, oh, it's going down, it's going down, it's going down. Right. Okay. So you're going to stare at something that's 15% of the market. Got it. Right. And that there are people who are playing there with balance sheets that are so small that they're looking to do to have a, you know, to buy 100,000 pounds to get help buying that in some instances. So you know, I think yeah, you know, there's nothing. there's no signal as to when these things turn. It's just you got to, it's the thing I always hear. What's the catalyst? I have no idea. I know the situations is set. The setup is not enough economic supply and too much demand. They rolled over because the spot price of uranium was rolling over a little bit, and and that caused all those buyers who piled in. It's the investors are mostly pro-cyclical. They
Yeah.
buy after a 20 or 30% move,
Yeah.
and then it pulls back, right? If you want to trade the market, you probably fade the moves a little bit if you were to think about it versus buy it's so basic, right? Buy the dips, sell the rallies if they don't go straight up over time, and you pick and choose how much you're going to do. But so yeah, but I do think the profile of the investor has changed. It's become more of it's becoming, there are bigger hedge funds playing in it, bigger funds playing it with shorter term time horizons that are very data point specific. And they're very successful often at what they do. I, at times they're very long this sector and at times they're short this sector because they're looking at data points. I personally don't think the data points they're focused on are the relevant ones. And that's just what makes markets.
Yeah. Next question. What's Mike's take on Lightbridge and ASPI and the potential for these technologies to scale rapidly if enough investment is secured?
No view. I mean, I know what they are. I stay away from mostly technology stuff because I'm tech's hard. Um, I, I I have a view that nuclear that my view in 2018 was nuclear doesn't even need to grow. My view now is, well, okay, look at that. Lo and behold, nuclear is growing, and we still don't, it's a supply issue, but now demand is coming out of the woodwork. So I just want to own the feedstock that supports that. As to what technology, I am not smart enough to figure out what will work. Um,
Fair enough, Mike.
so
Fair
I just
enough.
stay away from it. Yeah. I mean, I'm aware of, but I don't even, I'm not following them and other than just very from afar.
Got it. Next question. Rick Roll says that the easy money has been made in uranium, but in Mike's opinion, what is to come?
I mean, uh, that's good for him. My view is, um, maybe he's right. I take a different view. I don't know what easy money is defined as. I don't know what the expectation is. My view is because something has moved higher in price doesn't mean the value has changed or moved with it. So it's kind of like you buy a stock, I'm making it up. You buy a stock at $5 and it's $15, and people say, I missed it. Well, I don't know. Are the fundamentals materially better at 15? So the stock is actually cheaper at 15 than it was on 5? If that's the case, you didn't miss anything. And so, it's kind of the way I look at the nuclear investment thesis is price. Yeah, prices have moved up from $17, $18 to 80-ish and change. It's a nice move. But the fundamentals have dwarfed the move in that to the upside because demand that nobody was expecting is now everywhere you look. So that's got to get resolved. So maybe Brick's right. I've never met him, so I don't know. He's a brilliant investor from what I hear, and he's made a ton of money. So maybe he's right. I still think there's very nice asymmetry here in the trade. So I don't focus on what other people really or what their views. I hear them, I listen to them, but we have our own views driven by
Of
fundamental
course.
analysis, and that doesn't get swayed by somebody's viewpoint
Of course.
unless they present me with facts that are different.
Yeah. A few more, Mike. Is 2025 gonna be a year we will see 200 million plus contracting?
2025.
Yeah.
I don't know if 200 million is the bogey. My guess is it might, if which I am a betting man, that the rate of change is higher than lower. Yeah, so I would think it accelerates. Whether or not it gets to 200 million, I don't know.
Okay. Similar question. We covered Niger, but the question is, how do you see future of global atomic?
No idea. I don't talk about individual companies.
Sure, sure. Next question. I would like to know Mike's thoughts on China's SMR. Next month will be a year that it went live. Why aren't the Chinese building more? Why aren't they competing for export contracts?
Zero clue. No idea. Again, it's not part of my thesis. The
Of course.
SMR, the whole SMR thing, I don't put a pound of uranium. We don't put a pound here at our firm of demand in there because I have no idea when they'll come online. I have no idea which ones will work. I don't know.
Okay, final question, Mike. What uranium mines will come online in this decade?
This decade, that's a good question. I mean, some smaller ones will. Uh, and then it gets to, I know what people want me, what that question is designed is what they're asking me is Arrow going to come online?
Probably.
That's what they're asking. I don't know the answer to that. I think that
Not just Arrow. I believe that under this question is more of a Wheeler River and Fission Triple R. So
all of those, I think if you look at the history, these things always take longer than one might think. But I don't have any special insight. Again, there's all in our math, we bring a lot of them online by then because we like to model conservatively, and we're still quite comfortable with where the deficits are when we do that.
Mike, what can I say? Thank you very, very much for this session. I enjoyed it as always, and I look forward every time that I announced you as my guest. And I always really enjoy talking to you. And apologies for a lot of questions from my followers. Some of them were your area, some of them are not, but you
Yeah, no,
answered
no,
them.
they're all good. And look, there's a lot. It's my pleasure, and there's a lot. I don't know a lot about a lot of things. It really very narrow focus, supply, demand, just the feedstock, understand the fuel cycle, understand that whatever you think, try and identify catalysts. What I've learned over the years is hard here. And oftentimes the moves come when you don't, when you're like, oh God, another week, a month where nobody wants to own these things, and then all of a sudden something happens and you're like, and you always step back and you always remind yourself, like, that's right. It happened because the conditions are such where that should happen, right? And it's but more often than not in this particular sector, it seems like there's more down than up, but the up swamp the down at times. And then people tend to get excited at those tops and come in and buy them, and that's hard. So you just, yeah, it's tricky. It's a tough investment case. The supply demand is there. You just have to manage around it. I mean, the supply demand imbalances are there. A lot of things go into that. Like I said earlier, not to belabor it, you got some very smart investors coming in and into the trade now. I remember years ago, Lucian, where everyone would say, just wait till the institutional investors come, just wait. And then they come and they bring a different perspective to it. Smart folks that bring a playbook that they have, doesn't mean they're right. And they take both sides of it depending on how the winds are blowing and their fundamental view is at a given time. Short-term time horizon whips the equities around because they're small and thin. They're even, you take even the biggest equity, it still doesn't trade a lot. So on the grand scheme of things. So yeah, so it's volatile. Buckle in.